Views expressed are solely those of the speakers and do not represent this show or its team.
Interest rates can go up for good reasons and bad reasons. And if their interest rates are going up for good reasons, then stocks can go up too. But inflation is a bad reason for interest rates to go up. And that's what we're seeing now. We're seeing inflation expectations start to rise.
Welcome back to Built to Last, conversations about wealth, work, and life.
Gary, welcome back.
Great to be back, Wade.
So, Gary, in our last show, we talked about the structural shift in the global economy. We talked about what changed. Today, I want to talk about and focus on something that's more practical. I want to talk about what people actually need to be doing now. I want to talk about if the rules have changed, how have they changed, and what should investors and business owners and retirees be thinking about that's different. So let's talk about quarter one, Gary. It was a rough ride for a lot of investors. Markets moved around. They moved hard. They moved fast, and people felt it. They felt it pretty good. So let's just start there. Walk us through what actually happened in Q1 and whether it means what most people think it means.
Well, I don't know what people think it means necessarily, but in the beginning of Q1 in January and February, our thesis from last year sort of played out as we expected. And in fact, when we put out our early pulse on what we thought 2026 would look like, we said that it would look a lot like 2025. There would be volatility from the political sphere, that the dollar was likely to continue to decline, that interest rates on the long end would probably rise, right. And that stock markets, both U.S. and foreign, would likely just continue to grind higher. And we saw a lot of tailwinds for the U.S. economy, and those were greater than we thought in the headwinds. Of course, all that was flipped on its head on February 28th, when the United States launched a second war, or a continuation of the existing war on the Islamic Republic.
Right.
And, then we saw all these things reverse, right? We saw U.S. markets outperform international markets. We saw gold decline. We saw oil spike. We saw all these industrial commodities start to surge higher while gold went down. Interest rates continued to climb. But the dollar came back with a vengeance versus foreign currency. So all those things that were happening in January and February were totally flipped on their head during March. So, I think when I first came on board and we did our first halftime report, my theme was kind of like Charles Dickens. It was the best of times was the worst of times, a tale of two halves, or a tale of two quarters, I think I called it. This was a tale of two distinct parts, January, February, and then March.
So, Gary, if Q1 was the storm, let's talk about what's still standing and what are the important trends that, were there before all the volatility that you believe is still intact and maybe investors should not be losing sight of right now?
Yeah, I think, the trends that were in place at the beginning of the year are still mostly intact. And so, when we looked at what we were going to tell investors at the beginning of 2026, there wasn't a lot that I really wanted to change from my 2025 thesis. I think the grind in financial assets continues higher, that interest rates on the long end are likely to increase. But the one big beautiful bill, the tax refunds that are going to end up in consumers' pockets, the fact that unemployment is very low in the U.S., that those things are all going to continue to keep the engine of growth in the U.S. going. International markets are certainly more challenged in the current environment, but I think that the reasons for us wanting to be an international are still going to persist long after the Iran war and all of its detrimental effects has subsided. So, all in all, we think that investors really shouldn't lose focus on being cautiously optimistic for the remainder of 2026.
Well, Gary, you mentioned the Iran war, but there's still two conflicts going on. We have Ukraine and the Middle East. Obviously, investors are watching them both. So let me ask you directly, has any of that actually upended anything fundamentally? And if so, how permanent is that change going to be?
I can't say if anything is necessarily permanently changed. I think one thing that is likely to be changed and that we've considered in client portfolios is the price of energy.
Mm-hmm.
And I think we talked about that on our last show.
Yep, we did.
We think that the price of energy is probably going to be higher for longer. And we see the Trump administration trying to exit, trying to get the Strait of Hormuz open, trying to get trade going again, but it seems to be more difficult. And I think that was our general view of things. That once you've given Iran maybe the view that they can shut the Strait of Hormuz, that it's very hard to get them off of that without major concessions. And I just don't think that anybody is really interested in major concessions. So energy prices are likely to be higher, and energy derivatives are likely to be higher for some period of time. And I think that is I would say probably the only major change that we can see from this crisis.
Do you not see U.S. independence becoming a better factor for us here locally than maybe what we're seeing globally at this point?
I think energy independence is a crucial thing for national security.
Mm-hmm.
I don't know that it translates to the price at the pump because oil is a global commodity. That's the problem. We can drill all we want here. We can open Venezuela. We can do all of these things that will make the Northern Hemisphere or the Western Hemisphere more energy independent and more secure. Yep. But the fact is that all of these things are in a global distribution. And, we don't necessarily make all the diesel that we consume. A lot of that diesel is made in Europe and imported back to the U.S. A lot of the jet fuel that we consume is made in Korea. So, thinking about, that we are still in a global world where there's specialization, even those kinds of things that we consume on a daily basis, but the fact of that globalization means that we're going to eat the global price, whether we like it or not.
Right. And I think you nailed it right there, because we had some clients and people watching the show had questions about why we didn't believe prices were going to be coming down. I think you just absolutely knocked it out of the park right there. That explains the price at the pump and why we're probably going to be feeling that pain for a while. But here's what I've been thinking about: the hardware versus software debate. It's like, we've watched the AI trade dominate headlines, but there's a real question about whether the infrastructure behind the chip, so to speak, the data centers, the physical build out is actually a bigger story than the software sitting on top of it. Is this new? When compare it to energy, is this our new oil trade, or is this something entirely different in your opinion?
I think it's entirely different, although there are some that would say that, helium, a major component of of chip manufacturing, if Taiwan Semiconductor runs out of helium supply, that could mean that there's a slowdown in chip production. So it is somewhat connected. But if you look at a long run chart, just comparing semiconductor stocks to software stocks, this isn't a new trend. Over the past 5 years, semiconductor stocks have massively outperformed software stocks. And it's not because software stocks have been bad investments. On the contrary, these are companies that have huge gross margins, right? Mm-hmm. The incremental revenue that comes from not much additional effort, is massive, and those companies were rewarded with very, very high price to earnings ratios.
Right.
And what we're seeing now is that with Claude, with ChatGPT, with all these AI programs, that every day that there's a new release, that more and more capabilities that used to be the purview of these software companies is being eroded, and their moats are being eroded. And so the market is saying, hey, if I can't really predict that you're going to grow revenues 20 to 30% a year, it's really hard for me to pay a 30 to 40 times multiple for your company.
Absolutely. Yep.
At the same time, software companies or semiconductor companies got hammered late last year, in October through, call it February. And their price to earnings ratios, despite the demand story being there, and we think it is there. We think we're in early innings of this AI revolution. In fact, I was on a panel at a conference last week in Nashville, and I told the audience I thought that we were probably in the fifth or sixth inning, but this game was likely to go into extra innings. But those companies, their price to earnings ratios were very, very cheap. And so, in the month of April here, we've seen the VanEck Semiconductor Index up 30% in 1 month. So that's led us to rebalance a little bit at client portfolios.
Right.
But generally, we think that software is in trouble. Hardware is still a great place to be, and it's cheap relative to the demand, if that demand is sustained, and we think it is.
Absolutely. I think some of these legacy software companies, they got to rethink some of their thesis going forward, don't you?
I do think so. And, one of the things that I've been thinking is, that a lot of them are going to have to open up a little bit more and make the data that they've been keeping as their moat from the end users, make that more accessible, deliver AI tools to the end user and empower the end user. I think that is one way that those companies could improve the stickiness, because otherwise, I'm not going to pay for another seat. I'm going to hire some kid out of college instead at a lesser cost and say, go duplicate this and see what you can create.
Yeah, they're better off opening the gate and rather than someone knocking it, breaking through it. So I totally agree with you. Let's move on talk about inflation a little bit. So, interest rates have been the most debated, most predicted, and maybe the most gotten wrong topic that the markets have tolerated. Not you per se. We've talked about how well you've done over the past 3 years, but let's cut through the noise and talk about what is consensus missing right now, and what should investors stop believing when it comes to interest rates. I mean, you've done very good helping our firm and helping our clients walk through this interest rate environment.
Yeah, so we've been in the camp that long-term interest rates probably have to go up, and they've needed to go up for a number of reasons. One, the balance sheet of the United States and the huge amount of debt that we're going to need to print to fund Social Security and Medicare over the next 10 years plus is just going to make it so that it's going to be harder to find that marginal buyer. The only way that you can find that marginal buyer is to decrease the price, increase the interest rate, to entice people to want to buy that debt. Secondly, we thought that, with the one big beautiful bill, though, that, real GDP might be able to increase a little bit. And so you'd get interest rates rising for also the right reason of better growth prospects in the U.S. and the better growth prospects being sustained over long periods of time. So interest rates can go up for good reasons and bad reasons. And if their interest rates are going up for good reasons, then stocks can go up too. But inflation is a bad reason for interest rates to go up. And that's what we're seeing now. We're seeing inflation expectations start to rise. and therefore, the Fed needs to be very careful about that. Letting inflation expectations get out of control is going to be very bad for the U.S. economy, or for any economy where that happens.
So, one last question before we go to closing, and I'll need a direct answer on this. Given everything we've covered today, Q1, the wars, the hardware trade, inflation, rates of interest, are we risk on or are we risk off right now? And either way, why are we the way you say we are?
I'd say we're slightly risk on at this point.
So you think we're risk on right now?
I do.
Now you said slightly. Let's go back. So you did say slightly risk on. Okay.
Yeah. So we're the way that we manage money, we give ourselves a lot of leeway to be different shades of gray. Right. So it's not always black or white. We're not max risk on or max risk off, except in extreme situations.
Yeah.
But right now I'd say we're slightly risk on. We're a little bit above neutral in terms of where we want to be positioned, stocks versus bond, or taking on risk versus safety.
Well, now, I don't know if you want me to bring this up, but didn't you take some chips off the table today?
We did. Yes. We're always tactically looking at that. But the way that we take chips off the table, right? We have a couple of things that we can do. We can go all the way back to neutral, or we can just take enough chips off the table to get back into investment guidelines
and look for opportunities. I think that's one of the things you pointed out, right? So
that's correct.
Yeah.
And so we're not in the camp that we need to be bearish and go back to neutral, or really bearish and revise our targets lower.
Yeah.
We just think that, certain stocks, like we talked about, semiconductors, hey, they've gone up 30% in 1 month.
Yeah. And the year over year was over 100%, something like that.
We can take a little bit off the table and redeploy that to other places that have been beaten up a little bit.
Yep.
And I think that's just healthy. It's part of money management, right? We're selling high to buy something low.
Yep. Part of the thesis, like, you got to know when. Sometimes you got to know that when is enough, right?
Yeah, I think so. I mean, the problem is, like, when to know when enough is enough. Right?
Yeah. Especially when clients go, "Why
know
did you sell that again?"
Know when to fold them. It's that's the hard part.
Yeah. Well, we didn't fold. We just took some chips off and I think it was the right move. Actually, we were looking at a couple weeks ago, and I was thinking that at some point, the way this is going, it would make a little sense, and you made that move. So I appreciate that.
Yeah, it's not just, us deciding from our gut. It's, professional money management, having a set of investment guidelines, policies, procedures, ways to monitor our compliance with those things, and knowing when we're out of bounds and being able to get back in bounds.
When clients, like clients ask all the time, why did you sell that? And typically I say, because you wouldn't. I mean, that's what you pay us for, right? That's why we do what we do, to stay in that balance. And I think that's the one thing you made sure of, is you brought us back in balance by, that just over great growth, but it's it is semiconductor growth, right? So
absolutely. And we're going to get the hyperscalers reporting earnings here in a few, today's April 28th. So we'll get semiconductors and hyperscalers starting to report tomorrow and beyond. Yep. And so we'll hear from Microsoft, we'll hear from Apple, we'll hear from Meta, we'll hear from all these companies about what's really going on in the world. And we'll see if it was quote unquote smart or dumb to sell semiconductors yesterday.
Nah, I don't think it was dumb, no matter what. I think I think it was a good move. I never complain when I'm getting those types of returns in that shorter period of time. So I think it was a good move. Moving on to our 3-question close, right? Here comes the big one. The first one is, and I need straight answers, What is the one thing right now that matters most?
The one thing that matters most here is hyperscaler demand for semiconductor chips.
Mm-hmm.
I think there's been some questions around, around the Twitterverse. I don't think in reality, but there's been some question about, can all these hundreds of billions of dollars in orders continue, quarter after quarter after quarter? I think they can. I think they have to. It's sort of a requirement that it's either going to be us getting there first or China getting there first, and I think it's an imperative that the United States gets there first. And also, it's we're seeing it in our business. It makes sense to implement these things and continue experimenting with it, and every day it gets better and better, and that means we're going to want more and more compute.
Yeah.
But I think it's going to be important for investors to monitor that and to make sure that the Microsofts, the Metas, the Amazons, the Groks of the world are still in buying mode.
Yeah. So, looking over the next 6 to 12 months, what are things that investors need to understand before it becomes just plainly obvious?
I think investors over the next 6 to 12 months should be focused on sort of the direction of interest rates and why interest rates are rising, right? That question about, is it inflation or is it because growth is great?
Right.
And you need to be focused on whether it's the right reasons or the wrong reasons, because as we saw in 2022, when they're rising for the wrong reasons, that has big implications for other asset classes like stocks.
Absolutely. Yeah, absolutely. And the last question is, what do investors need to stop doing or stay away from right now?
I think every investor, and that includes us, we're closely examining what software stocks we own and why we own them, and how they can be disrupted.
Yep, I agree.
I think it's in huge focus. At the conference that I was at last week, we were talking a lot about private credit and alternatives and things like that. But I think ultimately this AI issue is much bigger than any of those kinds of issues.
Absolutely agree. Gary, thank you again. Very great, just awesome information, concise, and I want to thank everyone for tuning in to Built to Last. If today's conversation helped bring clarity to your thinking around wealth, work, or life, that's exactly why we do this. Until next time, stay focused on building something that truly lasts.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.